Climbing the wall of worry is where you have the S&P 500, which indexes all of the big companies in the US, and then you've got the QQQ, which indexes all of the big tech companies in the US. When these indexes are all-time highs and their forward earnings of 23x, which is historically the highest it's ever been, you start to have this increasing fear amongst investors, where if their portfolios are higher than they were before, they're increasingly more worried about losing what they've made. And so what happens is this increasing growth in earnings and the projections of where the S&P could go leads to this ever increasing risk of volatility at these higher points where people are starting to take risk off the table. What I've thought about in this increasing narrative of the AI bubble is that the actual impact of these companies becoming more efficient as they start to streamline their operations and their revenues, top line starts to increase as they become more efficient operationally with the increase in automation, is the revenues and the GDP is going to grow, and it's increasingly showing that at the moment, the growth that's come from the AI industry has led to the US not being in a current recession. So I want to go through in this video things that I've been thinking about. For the last few weeks, I've just taken time to really understand how to optimize for opportunities where you have these new industries that are forming. Could this be the beginning of an absolute growth in GDP and economic value for the investor within the specific companies that sit in the best positions for the AI revolution? Tesla, Nvidia, TSMC, Samsung, Meta, Google, Amazon, Apple, all of the big tech companies. Is it time to start to try and balance your portfolio in a way that you can actually try and participate in this opportunity, but also not get caught out if there is the increasing worry of there being a bubble? As the wall of worry continues to climb, you have these growing cracks in this potential flywheel of incestuous investing within the top companies. For example, OpenAI invests 100 billion in Oracle. Oracle invests that 100 billion in Nvidia, and then Nvidia invests that 100 billion back into OpenAI. And it represents this plug inside itself scenario. And when companies start to create their own incestuous flywheel, this starts to lead investors and spectators and commentators to start to think about whether there is actually fresh capital coming into these companies, or are they just reinvesting in each other? However, the growth in these companies' revenues really dictates whether we are in a bubble or not. And that's what I want to focus on. The forecast of the future GDP per capita when it comes to new industries shows these extreme accelerations when you have the Industrial Revolution. And now we're entering into the potential of the AI revolution, where there's deflation in services, there's deflation in the ability to travel, transportation, everything that people need. And as that happens, companies can run more efficiently. They can have less of the overheads, but also still function at a higher earnings. And that could lead to growth across all major economic zones that really participate in AI. However, the conclusion that has been formed by one of my favorite investors, Invest Answers, is that the Buffett indicator at 225%, that's market at a record over evaluation. The AI hype may justify valuations, but there are definitely bubbles out there. Debt and labor stress heighten the risk. Watch the AI progress. Markets could flip fast. Stay with the winners that make money already, Tesla and Nvidia. And as you start to de-risk, you can reallocate capital to companies that will participate meaningfully in this revolution. You've got Tesla with real-world transportation and humanoid robots, energy storage and auto bidder that can efficiently allocate energy at the right time for the grids. And then you've got Nvidia that are going to provide all of the GPUs across the world through sovereigns, and then also big companies that are going to need to have these chips in order to function and actually participate in the AI industry. So in this video, I'm going to go through some of the insights that I've been able to capture over the last few weeks. And it really determines how I position myself and how I make changes to my portfolio and how I look at being best positioned for the potential of this being an AI bubble. But also, if it isn't, to be allocated to this opportunity of a lifetime, whilst also being able to comfortably sit in something safer and more defensive like cash. And I've got some really important quotes from the great investor Charlie Munger and his book, The Wise Investor. And it really gets you to understand why cash is king, why cash is important, and why inflation impacts towards the cash that you hold and the potential future purchasing power isn't actually that important, because inflation can nibble away at your purchasing power, but panic can drop it off a cliff. And I just want to go through some of the insights and then round this video off with my portfolio and my kind of plan for the rest of this year. So, like, comment, subscribe, let's go. The Kabasi letter says that data center related debt issuance is at all-time highs, it's exploding. However, my favorite signal investor is AJ, and he says this is absolutely not a problem. He's analyzed the companies responsible for the vast majority, and these are the most cash generative companies on the planet, and their resulting leverage is still low. So their leverage related to their cash balance sheet is so low, and their top line revenues are so high and increasingly growing that this is not a problem, but it's definitely used to engage and lead to panic. These types of posts from the Kabasi letter are to try and engage people because fear sells. Cisco from 1997 to 2000 had a 55.7x P ratio, and people probably at that point thought this was over, this is a bubble. And then it went up to $80 from $16, and then it traded at a 210x P ratio. The reason that's important is because NVIDIA, considered the leader in AI and infrastructure build-outs, is only trading at a 30x P ratio. So you can see how there's so much more growth. And if you believe the narrative of the AI bubble, you'll never be able to participate in this potential opportunity. AI spending is continuing to grow with these top companies in the tens of billions all the way up to Amazon at 100 billion. And this is the spending for 2025. And this is guided to go higher in 2026. And those that worry about the AI bubble, those that worry about the tariff tantrums, those that worry about the macro continue to not outperform the S&P 500. And therefore, this is one of the worst years for mutual fund managers, showing that only 22% of the actual active fund managers have been able to beat the S&P 500, which is, again, not a great performance track record. And it kind of comes down to the fact that fear prevents you from being able to act. And at the times when you should be acting, the times when these managers probably should be allocating, is when they're most likely not, and they're probably selling or being defensive or not allocating. This chart shows that as the S&P 500 is up 17% year to date, the AA2 net bulls average is still a negative 11%, which means that the net of these high net worth investors, seen to be the most smartest allocators of capital, are net bearish, which means that as we approach all-time highs, that wall of worry continues, and you've still got the most sophisticated investor class, they're net bearish, which means that there's still room to grow. Since 1928, the S&P 500 return has been plus 8% on average. If you take away the top 10 best days, it's minus 13%. So basically, it's incredibly hard to time the market. If you miss the top 10 days of the year, you miss the growth, and you actually end up in a negative position. It's the top 10 days that give you that 8% on average, which is why it's so hard for mutual fund managers who try and select stocks and curate bespoke portfolios for their clients struggle to beat the S&P 500 because they usually miss those top 10 days. And then they have to play catch up at times where things have already started to move quickly. So trying to time the market is extremely difficult, and it can be done on a shorter term time horizon, but you've got to realize that the overall allocation needs to be within the index, within the companies that are going to potentially lead to the future growth and the future revenues. And as you can see, the performance without those top 10 days is 4%. However, if you had just been allocated for the whole year, you'd be up 24, 23%. And then this is another look at particularly Bitcoin, which is a liquidity-driven asset. The bull market always seems to happen during the TGA ceiling, which is where the TGA the Treasury General account starts to add liquidity back into the market. And as that Treasury General account starts to get replenished, that's when the downtrend in Bitcoin commences. But when that TGA starts to put that liquidity back into the economy again, that's when the Bitcoin bull market starts to continue. And we're now at the point where that's going to start to go back into the system. So it's something to really think about. Does it mean that Bitcoin's got more room to run? I don't know. But just understanding that generally Bitcoin really does like quantitative easing, which is basically the TGA putting the money back into the economy again. Hundreds of billions. Something that I really like to think about when I think about the Federal Reserve, and you can't bet against the Fed, is that their dual mandate is to try and make sure that the employment rate stays at a certain rate and then core inflation stays at the neutral rate, which is just around 2%. It's incredibly hard for them to navigate this. So they try and get that bullseye right. But if their core inflation priorities start to lag and start to reduce, and instead they start to focus on the fact that unemployment is growing, that's where you can ignore inflation readings a little bit and focus on the fact they're going to have to reduce interest rates just to help the jobs market. Now, this is more focused on Bitcoin, but it's something that I find really interesting. Bitcoin could still run, but you can see this divergence, this bearish divergence. As the price goes higher, the relative strength goes lower. And this is on a weekly. And usually when Bitcoin gets to about 44, it finds support and then it goes back up to this downtrending resistance line. What could happen is Bitcoin could bounce from here, go up to that trend line, it could break through and that could lead to all-time highs, or it could reject and it could come back down and break down past that 44 level, and that could signal a downtrend for a longer period of time. So how I'm playing this is I have Bitcoin that I will hold. I will track this particular reading and I'll start to trim at a certain level. When this starts to break under the 44, I might start to take a little bit off the table, but I'll always be allocated as I still believe in the fundamentals of Bitcoin. This chart from the market maker Wintermute looks at stablecoins, ETFs, and digital asset treasuries. And you can see here that the rate of change of liquidity is starting to drop off, which is why the crypto markets in particular have been in such a downtrend and they've really suffered from the TGA being out of order because of the government shutdown. And then you've got less money coming in and it's just basically being recycled. It's not new money. It's just the rate of change of the amount of money is going down. And that's the moment when the rate of change starts to drop. That's when these assets really suffer. So how could it all be relevant? I'm going to go through some of the insights that came from Charlie Munger and also just understanding TA and why it's important to sometimes not try and catch an asset as it's coming down. You don't just want to keep buying the dips because actually at times you can get the same entry after that downtrend and you can catch it without having to go through all of the sideways confusion and the panic that comes in these periods. So I'm just going to show you a quick TA of Tesla. And you can see, where would you rather buy, 1 or 2? Here you can see it's been falling and you think, okay, I'm going to really step in now and put a position together. That's fine, but you don't know when it's going to stop. So when you have tools like an optimized trend, you can just wait for it to drop. You can see it go sideways and you can wait for that trend to turn and buy at the same point, but without the risk and with a more assured entry where you know that this is now the start of an uptrend, not a continued downtrend. Just something that I think about. I'm going to go through these quotes because they really change my perspective on how I look at managing risk and how I look at managing my portfolio and how I look at managing, understanding the fact that I don't have a clue what the future holds for the markets. I don't know where they're going, but I have things that I look at, the signals that I look at, the macro indicators that I look at, the ISM, the fact that quantitative easing starts in December, rate cuts are going to continue coming down. Trump's going to put in a Fed chair that's going to be way more loose with the monetary policy. So there's lots of things happening on the broader macro, but I don't know what markets are going to do because they are completely irrational. This is why it's so important to understand how cash can be king and why it's so important to just always have dry powder ready for these moments where Charlie Munger and Warren Buffett really start to kind of show their wisdom when it comes to understanding investing. So cash is there to stop the clock. The cost of being overinvested in the market is that you can't wait patiently when you need the market to cooperate. You find yourself, when you're fully invested, you need the market to cooperate to get you back to where you were at the start, or you need the market to cooperate because hopes and dreams are in going up, but the market doesn't always want to go up. Sometimes it can go sideways and it can go down for longer than you could ever be prepared for. The lesson of 2026 is to avoid envy. And that's a lesson in life, especially when it comes to investing. During 2006, the real estate mania, people couldn't stand watching their neighbors buy houses and flip them for 50K, more 6 months later. So they jumped in and borrowed to do it. Some had 5 mortgages on 5 properties they couldn't afford, all because they couldn't stand seeing the other guy get ahead. By 2008, they weren't ahead anymore. They weren't even standing. It's this common phrase in the markets where you become envious and then you start to chase and speculate and make excessive risks, which just lead to you ending up worse off. So you should never chase. You should always replace and wait for things that haven't moved. What creates long-term value? Shift from the careerist income to equity income as early as possible. That doesn't mean quitting your job, but directing your savings into assets that give you a claim on productivity. Being able to allocate, I think, is going to be one of the most important abilities over the next few years as AI starts to really impact opportunities, jobs, white-collar jobs, and streamline operating efficiencies within companies. So being an allocator to capital or being a capital allocator to these productive opportunities is the best way to really protect yourself into the future. Leverage gives you speed, not control, but if the road ahead suddenly collapses, then the speed kills. Basically, leverage can give you a turbocharge, but if the road ahead isn't clear, if it's bumpy, if it's got a turn, if it's got a cliff drop, you're going to just go into that wall or go off that cliff quickly. And that's why leverage can be extremely damaging and dangerous. And I've experienced that so many times that I would say that using leverage honestly isn't really worth it. It can be with an extremely small percentage of your portfolio, but to be honest, people who use leverage eventually will find themselves going into that wall quicker than they would like. And that's just one of the lessons that I've learned personally. This is a really important quote, and all of these come from Charlie Munger. Inflation might nibble at your money, whereas panic will eat it alive. Markets reward restraint, and the world's chaos becomes your opportunity. Basically, yes, inflation can eat away 2%. When you look at the debasement of currency as well, another 10%. So you're looking at 12 to 14% over the year. And at some points, there's quantitative tightening, so it's not always going to be the case. It's actually going to be an average of a lot less. But panic and fear can destroy your wealth in minutes as you hit that sell button at the worst possible time. So just understanding that inflation, when you hold cash, can lead you to feel like you need to get back in the market. But actually just having cash gives you opportunity when chaos will happen. There'll be an opportunity next year where the VIX spikes up above 50, which means that there's so much risk and fear and worry in the market. And that'll bring down all of these opportunities again. And it plays out every time. Cash in the wrong hands is like ammunition wasted on bad decisions. I love this one. It's basically saying how you can get trigger happy when you have cash and you can basically end up shooting so many bullets at different opportunities. But sometimes just being patient and having that cash ready for that opportunity of a lifetime, which will come. And it every year always happens at the time when people least expect it. Wealth is invisible. It's the ability to walk away and own your schedule. This means that when you have some level of capital in the market, you're able to kind of think about a job differently. I want to do something that I enjoy. I want to work somewhere that brings me peace of mind. Maybe you don't need to focus on as much of the income part, which is trying to, work your way up the career ladder. Actually, you can have control over your schedule and you can put more time into the things that you enjoy. And so a job just becomes a option, a choice. I love working in education. So for me, I wouldn't mind ever going back to that industry again one day, but it's to choose in what capacity, in what way do I want to be in that school, in what way do I want to be in that industry. And therefore, that's what wealth is. It's not luxury. It's not all of these fancy things. They just end up being shackles in the future. And again, this has just come from this book. Reading this book, understanding these lessons has made me think about portfolio management a lot differently. Okay, this is the look at my portfolio now. It's changed a little bit over the last few weeks, but I keep saying I'm going to raise cash. I've got Tesla still at a large position, but it's starting to come down as I try and aim for about 50%, but I'm waiting for things to move up. And then when it does, I take a little bit off and I put it into the cash position. I've still got Nvidia. I've now built up a position in Meta with profit from Tesla. And I've also reduced my Solana position significantly because it's come down a lot. But I also realized that my cost entry was low. So I want to start taking some of that off the table, regardless of how much further it goes. I don't really care. Bitcoin is something that I love. I will hold for the rest of this decade. And then I've got my index, which just basically keeps me in all of the sectors for the whole year. I hope you got some value from this video. This is just a kind of insight into how I look at the rest of this year in 2026 and then the rest of the decade. But also just hopefully there's some quotes in this video that can really sit with you and get you to really understand how cash really is king. Being defensive and starting to take risk off the table can give you peace of mind. Balancing your portfolio in a way that can be positioned for growth, but also is positioned for downturns that will inevitably come. Whether we're in a bubble or not, you're able to kind of participate in every direction. So again, I hope you got some value from this. If you did, like, comment, subscribe, and I will see you in the next one. But before I say that, this might be the last time that I'm in this apartment. And so my videos going forward, they might be me walking around somewhere. They might be me in just some random location. Again, there's no formalities to this. This is just an archive of my insights, an archive of my journey as an investor. And I want to look back on these videos one day and be able to go, okay, that's how I looked at things then. And maybe things have changed. If you get value from these videos, that's amazing. I will see you in the next one, whether it's in this room or just somewhere else where I'm kind of exploring and sharing my thoughts. So thanks. Like, comment, subscribe. Bye.